Hi guys, so we'll be looking at ratio analysis in this lecture, and you will definitely going to agree with me that you can have a complete view of financial management of any company without understanding ratio analysis, because when you want to take decision you need information, and this information sometimes in itself does not make any sense. But when you're comparing one information to another, what you are doing is you're calculating a ratio, and in that case you're able to make some informed decision. Likewise, you want to see maybe how a company is performing well compared to other company, or compared to the industry, or even compared to the past performance, talking about trend analysis. All you're doing is analyzing data, and that is ratio analysis. So I'm going to summarize everything about ratio analysis in this recording, and I'm going to solve question in the next video on ratio analysis. So please pay attention to this. What I'm going to cover in this recording is to explain the meaning of all the ratios that you need to know. So I'm going to explain the meaning. Yeah, because it's very important you understand the meaning, not just understand the formula or memorizing the formula. So when you know the meaning, then you also need to understand the interpretation. So extremely important. If you calculate a ratio, which is easy to calculate, all ratios are easy to calculate. It's about dividing one number by the other, right? However, that is just in the days of management accounting. In financial management, you are meant to understand beyond the calculation. In fact, the majority of your marks will come from your interpretation, which you cannot do without understanding the meaning as well, right? So the calculation is easy, and that's why I'm going to solve a question after I've explained the meaning and interpretations to you, right? But the focus today is to deal with these two guys, the understanding, right? Right. So the way the question will usually be framed is to give you a financial statement or other financial information, and you'll be asked to analyze the company's performance or analyze the company's position based on ratio analysis. They will not necessarily give you a particular ratio to calculate. So you should decide what you need to use, and that's why I think most students struggle a lot, because they don't know what ratio should I calculate, or maybe they are even struggling to remember what are these ratios. So what I've done is to group these ratios into 4 categories to help you, such that anytime you want to do analysis, ratio analysis in a question, you are thinking of those 4 groups of ratios, and you are able to churn out the relevant ratios to calculate, and you deal with it. So we're going to look at the types of these ratios, and the types that I've grouped them into, there are 4, and they are based on the focus of the ratio. So by even knowing the type, you already know what the ratio is trying to calculate. So the first one that we're going to look at is the profitability ratio. So we'll look at profitability ratios, and under that, we'll look at 2 ratios, which is return on capital employed, and we'll also look at return on equity. The second group of ratio that we'll look at is the liquidity ratio. And under this one, likewise, 2 different ratios we're going to look at: current ratios and quick ratios. The third one is going to be on risk. And here we'll be looking at operating gearing ratios, we'll look at financial gearing, and we'll look at interest cover. So these are the 3 types of ratios we'll be looking at under the risk. The last one is what I call the shareholders ratio. Yeah, or some people call it stock market. Or same thing, stock market ratios. And here we'll be looking at about 5 ratios here. We'll look at earnings per shares. We'll look at price earning ratios. We'll look at dividend cover. And we'll look at total shareholder ratio. TSR. So that is a summary of the ratios that we'll be looking at today in these 4 categories: profitability, liquidity, risk, and shareholders or stock market ratios. And that's how we're going to deal with it. And you can see it. Profitability ratios, we're measuring performance. This is about the performance of the company in terms of profitability. This is looking at how liquid a company is, that is, how is this company able to pay its immediate obligation using short-term asset. Risk is looking at the stability of the company. How risky is this company is. Shareholders market or stock market ratio is looking at how much returns are shareholders able to get from this company. Those are the kind of things, and that is how I've grouped those ratios into 4. And we'll go into there's no other ratios you are meant to understand in ratio analysis of this paper that is outside of all of this summary. So don't struggle to calculate ratios again. Don't struggle to remember what ratio should I calculate again. Just try and understand these categories and everything works for you. So if your company is in your question and the question is asking you to analyze the company's liquidity, you know that you are dealing with this. If they're asking you to talk about the profitability, you are dealing with this. If they're asking you to talk about or analyze the company based on risk, then you are dealing with this. If it's about the shareholders, then you are dealing with this. And if the question is silent and it's just saying analyze the company's performance based on the available information, then you know that you consider this 4, but based on the available information that you have. Because if you don't have information on current asset, you can't calculate liquidity. But if you have it, you calculate it and you interpret it. So that is what we're going to be looking at today. So I'm going to be taking each of those type of ratios, tell you their focus, how they are being calculated, and the interpretation. And that's what I'm going to do for each of them. So let's start with the profitability ratio, the first one. And the first one under profitability ratio that I mentioned is return on capital employed. And what does this measure? This just measures how much operating profit a company is able to produce or to make using the available financing. So we're saying this ratio will answer this question. How much operating profit operating profit is your PBIT. How much operating profit is a company able to make using available finance. Available finance, remember, is your capital employed. And that is why the formula is profit before interest and tax over capital employed. And remember that capital employed is your debt plus equity. And to also mention, when we talk about debt, we are talking about only long-term debt. Please take note. Only long-term debt. And in terms of interpretation, the higher the better. Please take note. The higher the better. And usually you have to compare with a benchmark. So usually you want a return on capital employed that is bigger than the benchmark figure. And your benchmark either be your prior year ROCE. So if it's bigger than the prior year ROCE, then it's good. Or you are using the industry average or the peers. Yeah. Or it can even be the company's target or policy. Because some company will say our ROCE is expected to be 20%. So if an investment or a company is now generating a ROCE of 19 or 18, you know that is bad because it's less than the target. Yeah. So the higher the better, please take note. And that's it on ROCE. The next one, 1B, is the ROE, which is return on equity. This is slightly different from ROCE because this one measures profit after tax, not profit before interest and tax. And what is it measuring? It's measuring how efficiently has a company used equity to generate profit after tax. So I'm saying how efficiently has a company used available equity to generate profit after tax. And that is why the formula is profit after tax over equity. And when we say equity, please note that we are talking about share capital and reserves. And your reserves usually include things like your share premium, just to give you a bit of reminder on that. Share premium, retained earnings, and other reserves. Please take note. In terms of interpretation, same as ROCE. The higher the better. The higher the better. So usually you can also have comparison benchmark. Please take note. And that's it for the first group of ratio. You can see. I mean, if you have a financial statement, I believe you won't struggle to identify what is profit after tax and what is equity, right? But like I said, I'm still going to solve questions after this explanation, just to refresh your memories. But I need you to understand interpretations first, the meaning, because that's more important than any other thing. Now, let's look at the second group. The second group is the liquidity ratio. And here we'll be looking at two types as well. The first one is the current ratio. And this one measures ability of a company to settle its immediate obligation. It's immediate, or you can call it short term. Things like account payables, short term obligations. Using short term asset. Short-term asset. These short-term assets are things you call liquid asset and all. So that's what current ratio is looking at. And that's why the formula is just your current asset, which is this, divided by the current liability. Which is just this. Usually, in terms of interpretation, if it is greater than 1, then it is good. And if it is less than 1, then it is bad. And also good to know that current ratios varies based on industry. Generally speaking, you expect manufacturing industry to have higher current ratios than service industry. In fact, the rule of thumb kind of is to know that when companies have a lot of physical assets where that has to be depreciated and all of that, they tend to have more fixed costs, and because they're manufacturing as well, they're going to have a lot of inventories, so their current asset will be high, right? Because of inventory that is stored. But if you look at service industry, I don't keep a lot of inventory. So generally speaking, it's only account receivable they will have and might not have so much of high current ratio. Now, the 2B is the quick ratio, which is also called the ACCA test. Quick ratio. You might see it in some literature where they call it as ACCA test ratio. Yeah, this is just the same thing as current ratio in terms of everything we've said. The only difference is that it makes adjustments for less liquid asset. So it makes adjustment from a less liquid current asset. So this ratio believes that not all current assets are very liquid. That is, not all current asset can be easily converted into cash. And this particular asset in question is the inventory. So it believes that inventory should be taken away from current asset for this part of analysis. And that is why the formula is current asset minus the inventory divided by similar current liability. Right? And in terms of interpretation, it's the same as the current is similar as current assets. The higher the better. However, you want a quick ratio that is also greater than 1. Yeah. In fact, for current asset, the best is to even have more than 2. This is fantastic. But if it's more than 1, it's still good, because it means that you are able to cover your liability. Yeah. But ideal is you really want something that is more than 2 for current asset. And if you're talking of quick ratio, 1 would be your ideal. Yeah, but at least you still want something greater than 1. But if it's less than 1, it's bad as well. If it's greater than 1, it's still good. Yeah. So for quick ratio, you understand that it might not be up to 2 for ideal. But for current ratio, you expect ideal to be at least 2. But if it's not even up to 2, like I said, if it's more than 1, it's still good. It's okay. It is not bad. Okay. That's for the liquidity ratios. Now I move to the third one, the third group, which is about risk. Risk. And what is this looking at? This is generally looking at the stability of a company. Stability of a company. How long can this company exist without problem? How long can it exist paying dividends to the shareholders, paying the interest to the debt providers without problems, without volatility? How stable is this company? That is what this ratio is looking at. And there are 2 types of risk that are involved here. The first one is the business risk. Business risk. And the second one is the financial risk. Now, when you talk about the business risk, you're talking about the risk inherent in the business. Because you're in that industry, there's nothing you can do. You are exposed to that risk. However, if it's financial risk, you are the one that is asking for that risk. And how are you asking for that risk? Because you have gone to collect debt. And that's why for business risk, we'll be looking at operating gearing, And for financial risk, we'll be looking at the financial gearing, and interest cover. Those are the ratios we'll be looking at. So for operating gearing, what are we looking at? We're looking at risk associated with the level of fixed cost that a company has. That's what we're looking at. Anytime we're looking at operating gearing, it's about the risk, associated with the level of fixed cost. That is the problem. Fixed cost. Remember that the fixed cost that we're talking about is influenced by the nature of the business. So fixed cost is highly, let me put it like that, highly influenced by nature of the business. Like I was telling you before, if you're in a manufacturing industry, you're going to have a lot of fixed assets, so you expect a lot of fixed cost. And that will increase the volatility of your profit, because the higher the fixed cost, the lower the profit. Contribution will be the same as profit if there is no fixed cost. Whereas anytime you have a fixed cost, you realize that your contribution is not the same as your profit after tax. Right. And what's the formula for analyzing operating gearing? You need to calculate your contribution. Remember, the formula for contribution usually is your selling price minus variable cost. Remember? So contribution divided by profit before interest and tax. This is your operating gearing formula. So this is what you're supposed to calculate for operating gearing. And your profit before interest and tax is the same thing as your operating profit. So generally speaking, let's say if fixed cost is equals to 0, what that means is that your contribution will be equals to your profit before interest and tax. And therefore, what happens? Operating gearing will be equals to 1. So which means this is mostly, practically speaking, your best case scenario. Minimum gearing you can have for operating gearing. However, by the time the fixed cost starts to increase, then what happens to profit before interest and tax? Profit before interest and tax will start to come down. And if it's coming down, it means that contribution will be greater than profit before interest and tax. And what happens to our OG? Our OG will start to increase greater than 1, because the numerator is now bigger than the denominator. And that is why the lower the better for operating gearing. We don't want it to be high, because high means fixed cost is high. And we want to minimize our fixed cost as much as possible, because fixed cost makes our profit to be very volatile. Okay, we'll go to 3B, which is about financial gearing. And there are two things we'll be looking at under financial gearing. First of all, we're looking at how much debt a company has compared to its equity. Remember, too much debt makes a company to be unstable, because shareholders will be very unhappy seeing so much debt, because they know that two things: interest will be based on debt before they pay profit after tax. So dividend will be impacted if you are paying so much interest on debt. Likewise, if there is a liquidation, then the shareholders will be ranked lowest, which means the debt holders will collect all the assets first, and there might be nothing left for the shareholder. So too much debt is not good, and that is why gearing, financial gearing, increases the volatility of a company, makes the company to be unstable. So the first thing we're looking at is how much debt a company has. Like I said, when you compare Yeah, and there are two ways for calculating this. Either you use your debt divided by equity, and that's why it's called debt equity ratio. Or total gearing ratio. If it is total gearing ratio that you are trying to calculate, use a different formula. Either of them is allowed, and if it's a multiple choice question, you'll be told which one to calculate. If you say debt equity ratio, you do this. If you say total gearing ratio, you do debt over debt plus equity. Okay. The second part of financial gearing is the measure of ability of a company to pay interest expense, yeah, on its debt. That is how comfortable a company is to pay interest on the debt that is owing. And that formula is profit before interest and tax, which is where the interest will be coming from, divided by the interest that has to be paid. Interest expense. Yeah? And in terms of interpretation, for this guy, the lower the better. We want to have a low gearing. However, for this guy, the higher the better. Because if it's higher, it means that you are comfortable. Please take note, the higher the better. The higher the better. And that's it for the third group. The final group is the shareholders ratio or the stock market ratio. Yeah. And there are a couple of ratios we'll look at here. The first one is the earnings per share. Earnings per share is looking at how much profit is available to ordinary shareholders. Remember, they are preference shareholders, so we are not looking at preference shareholders. We're only looking at ordinary shareholders. So how much profit after tax is available to ordinary shareholders? That's what we are checking. Is there anything left for them to share as dividend? That is the question we're answering. And let's say how much is available is their profit after tax, right? Divided, because this is the total that is available, but to how many shares? Divided by the number of ordinary shares. So that's how we know for one share how much profit is available. Yeah, on one share, to make it clear, right? So this profit after tax has to be without preference shares dividend. So if there's any preference dividend that has to be paid, please deduct it, less preference dividend, because you need to be looking at the profit after tax that is solely available to the ordinary shareholders. So if that company has some preference shareholders, then we need to pay them first before we use the formula to calculate EPS. The second one here is the PE ratio, which you call the price earning ratio. Very popular. Price earnings ratio. Price earnings ratio. Yeah. This one measures growth potential. That's what price earning ratios measure of a company. If I want to buy shares of any company now, P ratio is one of the things I'm going to check as a potential shareholder. If the P ratio is too low, that means the potential of that company to grow in the future is too low, and I will not buy it. So I'm interested in companies with high P ratios, because that is an indication that this company has high growth potential. Yeah, and the formula is very easy. It's just in this same word, price over earnings. So it's share price divided by earnings per share. Yeah, and if we want to use the total value, you can also say divided by total market value. So you can say total market value divided by profit after tax. That's total. Yeah, because this is total earnings instead of earnings per share, and this is total market value instead of just one price per share. Yeah, and this total market value is also called the market capitalization. Yeah, remember how to calculate that in case you're not given. If you want to do it, market capitalization is just your share price multiplied by the total number of shares in issue. Total number of ordinary shares. That's a market capitalization. Yeah, in terms of interpretation, likewise, for this, sure, the higher the better, because the higher your growth potential. So the higher, the better. Very important. Yeah, for earnings per share, I told you. Let me write it here as well. The higher, the better. We want high EPS. Now, the third one is dividend cover. Dividend cover. These are the interest of, remember, shareholders who have invested in a company. So if you are calculating dividend cover as a ratio, what you are checking is you are checking the ability of the company to pay dividend. The same question, how comfortable are you paying dividend? So you don't need to memorize all these formulas, because where will the dividend come from? It's going to come from profit after tax divided by the dividend per share. That's it. But to compare likes for likes, let me not write it this way. Because profit after tax is the total dividend available, right? So the question is, are you sharing all the earnings? Most likely not. So whatever you want to share as total dividend is the cover you want to calculate. So take, for instance, if a company is making 100 million as profit after tax and it wants to declare dividend of 50 million, then that means the dividend cover is 100 over 50, which is 2, which means this profit after tax can cover the dividend declared twice. So that means we are comfortable, right? And if we want to do it in a unit form, then instead of using total profit after tax, you can use earnings per share, because earnings per share is the profit after tax per share, right? Then instead of using total dividend, you use dividend per share. So that's how you get used to the formula, right? So it's the same answer you're going to get. And likewise, like the other ones, for this one as well, the higher, definitely the better. Okay. The last ratio we'll be looking at is the total shareholder ratio. Total shareholder ratio. Total shareholder ratio. And the focus of this one is to measure the total return. So this one measures the total return received by a shareholder. Yeah, from holding 1 unit of share. Yeah, so the total, what is the total benefit from holding 1 unit of share? That is what this is calculating. Remember, this is different from return on equity. It's not return on equity. Return on equity, you're only looking at profit after tax. You're only looking at something related to dividend. That's what return on equity is looking at. But that is not what we are looking at here. We are looking at something beyond dividend. Because when a shareholder invests in shares, remember, there are 2 ways of getting benefit. So when a shareholder invests in shares, dividend is just one way of making returns. If you remember the dividend irrelevance theory, this is irrelevance theory, not residual theory, where a shareholder can get returns from dividend and can also get returns from capital appreciation of the shares. So you could make money on that dividend from the dividend the company is paying, and also you can sell the shares and still get capital gains. So both of these is what the total shareholder return is looking at. And that is why the total shareholder return is calculated as the dividend per share, which is the dividend for 1 unit of share, and also the capital gain from 1 unit of share. So plus capital gain per share, divided by the share price at beginning of the year, just to get the return per invested amount. So you make this profit, then you divide by the amount you invested beginning of the year. That gives you the return per the capital gains you make for that particular share. And definitely, you know that the higher, the better. So that is the summary of everything you need to know on ratio analysis. The next video, what I'm going to be looking at is going to be calculation. Until then, continue to like, share, comment. If you have any questions, let's talk about it. On to the next video. Bye now.